It's a great pleasure to welcome to this forum Ryan O'Connor, President and Portfolio Manager of Crossroads Capital. Prior to founding the firm, Ryan was a portfolio manager at Three Arch Opportunity Fund, a value-centric investment partnership based in San Francisco. Before that, Ryan co-managed portfolios at Whetstone Capital and Cush Capital, two Kansas City-based investment partnerships focused on public equities. Before life as a securities analyst, Ryan studied economics at Indiana University Bloomington, spent time as a top producing financial advisor for A.G. Edwards, now Wells Fargo, and an options trader on the Chicago Mercantile Exchange. It's been a great pleasure, Ryan, having you with us in the past. I really enjoyed your presentations, and I look forward to this one as well. I'll turn it to you, and I'll be back at the end for the Q&A. Please go ahead.
Thanks, John. Appreciate it. So today I have kind of a unconventional name for a Wide-Moat conference of all themes. We've kind of taken an unconventional approach to this by choosing a company that is, typically by and large the opposite of a Wide-Moat business. Mortgage REITs in general are, not that much, not far off from basically a executive compensation scheme masquerading as a investment business that is, typically even worse, than, hold on, let's pull this here. Sorry about that. Orkin Island is typically a very mediocre business that, for all intents and purposes is guaranteed to blow up once a cycle. So not without some sense of irony, we think a very unique confluence of events has, created kind of the opposite setup. I guess first I'll quickly go over the nature of, an agency MREIT. It's a very simple spread business. Typically they use various forms of rather extreme leverage to borrow money short in the repo market, and they lend those funds out long in order to kind of amplify the returns. These returns are then typically paid out as dividends to your prototypical kind of low information yield seeking investor that is looking for current income. Well, as I mentioned, once a cycle, these businesses typically blow up. And part of what makes this setup unique is that first, the securities that make up Orchid's investment portfolio are by and large, or not by and large, but 100% agency securities. And that means that basically they invest in mortgage-backed securities that are issued by government-sponsored entities, the GSEs, Fannie Mae, Freddie Mac, and Ginnie Mae. They're qualified and therefore literally bulletproof in the sense that, worst case, even if borrowers default, the GSEs, implicitly backed by the U.S. government, will make the timely payments on principal and interest. What makes, I guess, this setup, particularly unique is that once a cycle blow up and the kind of panic selling and forced sales that caused, the industry itself to blow up. I mean, I think the MREIT space in general was down something on the order of 60 or 70% at the lows. But that has, kind of that indiscriminate selling pressure has, created a very unique opportunity for people that are kind of more discerning between, the nature of what individual MREITs hold in their portfolio. There's a small group, and typically within our portfolio, we have taken a basket approach. But we basically ended up purchasing a basket of MREITs, ORC being one of our larger positions at a steep, discount to a government guaranteed book value with a sustainable and growing mid-teens dividend yield. we think, this unique confluence of circumstances, which I'll get to here shortly, has effectively taken, truncated the downside, allowing you to, and we'll get into this later, but buy a dollar bill for options adjusted prices of essentially 60 cents on the dollar. That purchase price, I think, is notable, in and of itself, but it really starts to get crazy when you realize that, in whole, the government's actions have basically underwritten a trajectory where you're going to see a step change inflection in its underlying earnings power. So, you have basically a rapidly growing dollar bill that you can purchase, at a steep discount, where, there's essentially no practical way one can lose money. So this next slide is, kind of the moat we were talking about. Again, this is typically a no moat business, pretty much the opposite of the types of securities that we like to buy. By nature, we kind of look for the absolute slam dunk no-brainers, if you will. We want our businesses to be inherently defensive, highly resilient, with staying power and, a fair level of anti-fragility, in that these businesses should be able to hold their own, if not, grow during times when the economy is weak and investors are scared. In the increasingly uncertain world of today, I think that, ORC offers essentially what is, I call an unlimited money pure play on, the Fed's actions. And an idea that is, not only not correlated to the pace and success or failure, unfortunately, regarded to the reopening, but it has basically has very certain prospects combined with an extremely low likelihood of loss. And that combination, especially in our increasingly uncertain world with, interest rates at zero, you have something that has just a very predictable nature to it, solid downside protection, and multiple catalysts. Namely, a bid will return to these stocks, basically due to two upcoming factors. With interest rates pinned down at zero, their higher cost repo paper is in the process of rolling over. As that does, their NIM should expand substantially. And the implied dividend yield on kind of normalized earnings power in combination with the discount to book creates a very, very attractive setup where, I think it may take some time, but eventually the income-seeking, yield hogs will return to the space, within, I think, a reasonable amount of time. So let's see here. Let me go through these points. So, as I just mentioned, Agency MREITs, the entire 100% of ORC's portfolio is backed by essentially the full power of the U.S. government, eliminating their credit risk. They literally cannot be defaulted on. So this is, I think, the first thing I take away that I want to make, very, very clear. In a scenario like we have today, where the ultimate fallout in terms of not only, public health, but the ultimate impact on the real economy is so uncertain. The ability to basically essentially buy a literal dollar bill at a deep discount is, I think, uniquely attractive. As I mentioned, you had a bunch of forced selling from low information investors, and I think still to this day, you do not see the MREITs, trading as they should. I mean, it's kind of remarkable in a backdrop where, the Fed has essentially created nirvana for the MREITs. They tend to, bounce around like trading sardines. And I think that these days will swiftly come to an end as a few factors about the present reality come, I think, better appreciated and better known. The first is the nature of its portfolio, and the inability, the zero credit risk when credit risk is particularly high is attractive. But more importantly, on March 23rd, when the Fed stepped in and announced basically that they would, put unlimited purchases towards AGMBS to restore the proper functioning of the mortgage markets, not only do you have kind of, the downside protection, on the investment portfolio there, but in doing so, they essentially eliminated the liquidity and funding risks that are kind of the bane of this business model in one fell swoop. So let's move on to the next one. So as I mentioned, the Fed is printing unlimited amounts of money and using it to buy agency MBS directly. So, when you think about the power of the Fed's printing press, this is one of the extraordinarily rare scenarios where it's not, they say don't fight the Fed, and typically, the only way you can do that is by investing in stocks or bonds or capital assets, in general, as that all this money printing tries to find its way into a home, one of the indirect secondary tertiary effects is to push up capital assets. Well, this is unique in that, this is literally a direct, beneficiary, and it's not only, a function of, their ability, the government's ability to step in and make good on the timely payments of principal and interest, should, the underlying portfolios in their loan portfolio, or the underlying loans in their investment portfolio default. But, there are indirect ways too that the business will benefit. So besides guaranteeing the portfolio, the Fed basically is anchoring rates at zero. And in doing so, they are basically ensuring that ORC's net interest margins explode. So again, the common risks associated with this business model and the things that make it attractive have suddenly been taken off the table. The Fed is essentially guaranteeing the smooth functioning of mortgage markets, and in doing so, they are eliminating not only the credit risk, but the funding, liquidity, and interest rate related risks at the same time. So I guess, in summary, to kind of go over that one more time, MREITs felt the effects of the pandemic early on. Usually in periods of distress, people sell, not what they want to, but what they can. And oftentimes this kind of results in a flight to quality, the higher quality names getting sold off and, lower quality names kind of rallying. But, in this case, you had a situation where, businesses around the country started drawing down on their revolvers, and that kind of created a chain reaction of events that were felt, was felt in the MREIT space very early on. Severe distress in the short-term funding markets set off a cascade of forced selling pressure. As liquidity dried up, repo loans were pulled, and the prices of MBS assets imploded on the back of widespread margin calls. It's interesting. You don't see very often times where, securities that are, government guaranteed end up, trading below par, but temporarily in March, that's actually what happened. And that was actually what caused the Fed ultimately to step into the breach. But anyhow, so, you had the typical cyclical blow up take place. And, when you marry that with a generally unsophisticated yield or orientated shareholder base, kind of crowding the exits all at the same time and ignoring, levels of credit quality and other variables among publicly traded peers, you have a setup for interesting things to happen. By late March, the Fed had not only cut rates to zero, it had effectively announced the limited support of the MBS and repo markets, ensuring funding and liquidity issues wreaking havoc in mortgage markets would cease. Collectively, all this stuff not only restored the proper functioning of mortgage markets to health, but you saw agency MBS, price, basically quickly return to prior highs. And again, I think that all of these things have come together to create an opportunity where the Fed can buy, or you are literally buying assets, that is, you're buying a dollar bill for 60 cents. despite dramatically enhanced earnings power and normalized dividend yields as kind of the pig works its way through the python and higher cost paper, that reflects their economic cost of funds resets lower, you're going to see huge NIM expansion and, in pretty much across the board in our basket, normalized dividend yields well north of 20%. So I'm going to go over here, kind of the big elephants in the room and discuss, all of the factors that I think, not only historically are relevant to handicapping, uncertainty in the downside in these names, but that are, directly relevant to this situation. So credit risk, the risk of not getting repaid by a borrower, very simple stuff. Again, as we've already mentioned a few times, ORC faces zero credit risk on its portfolio, and payments on that portfolio are literally guaranteed by the government. Just to kind of quickly go through here, the way these risks, actually scratch that. So I'll stick to the list. So liquidity risk, the risk of being unable to sell assets at reasonable prices when necessary. Again, the Fed has committed to buying limitless quantities of agency MBS, stabilizing their prices. So, the kind of, cascade and secondary market prices that happened in March and kind of kickstarted the chain reaction that drove the margin calls and eventually a lot of implosions, across the space, has been taken off the table. The next is funding risk, the risk of being unable to roll over short-term financing. Typically, this is where, these businesses typically get in trouble. The levering up and basically doing carry trades works great, until, it doesn't work. And usually, these blowups are necessitated by periods of distress where things get weird and the short-term funding market sees up. Kind of the original sin of these businesses is lending short or borrowing short and lending long. So, typically the way funding risk works is ORC finances its investment portfolio with repos or repurchase agreements. The way that works is ORC will pledge, $100 million of MBS as collateral to a bank in exchange for cash and the promise to repurchase the MBS at a specified future date. The bank applies a haircut, and, loans, against the $100 million loan, usually it's about 10%, and the ability to ask for more collateral if the value of the MBS falls below a specified amount. So ORC takes the 90 million, purchases MBS that could be pledged in repos to get more cash to purchase more MBS, and the virtuous circle, of deleveraging basically kind of rolls on. But the interesting thing about this, and this relates to, short-term markets funding up, is, these businesses are essentially in a constant state of refinancing. I don't have the chart here. I might actually add it back, but if you look at their June 1 press release and pretty much all their materials, they give a breakdown of, their portfolios and, when they will roll over. But, they're basically in a constant state of refinancing. For example, 633 million of ORC's portfolio, if I'm remembering correctly off the top of my head, of their 3 billion in total investments, are due to be rolled over in the next days. So, when repo markets seize up, as they did in March, they essentially can't refinance and thus have to come up with cash, to repurchase the pledge MBS or risk the seizure and sale of those assets by the bank. Normally, you would be able to simply unwind the repo by selling the MBS in the secondary market, but in times of distress, and like we saw in March, everything seized up at once, and there was basically no ability to do so. So that kind of dovetails into liquidity risk, which again, put simply, liquidity risk is just the risk of not being able to convert assets into cash in a timely manner. Agency MBS are typically very liquid, as you would guess, due to their government guarantee. But again, prices fell in secondary markets as there was kind of a dash for quality. Despite them being guaranteed by the, government, but, it was kind of into this, environment that we saw the Fed step in and restore order. And that kind of sent, secondary market prices back to 52-week highs. As an extension, this kind of removes the liquidity risk involved. Now we're in a situation where the Federal Reserve is ready to purchase, or repo agency MBS in unlimited amounts. And it was kind of this event in particular that was the impetus for us kind of diving into the space. Again, categorically, this would be an investment that we would avoid, on principle in a number of ways. But when the Fed stepped in and, you basically had a situation where it created, much like the banks following 2008 and the financial crisis, I always remember that interview with David Tepper where he talks about, he was going to go to the green grass and, basically front running the Fed in, buying up assets that were basically guaranteed the Fed had committed to purchasing at higher prices. So, when I saw this, having kind of gone through, I came of age and kind of had my baptism of fire in this industry through the financial crisis. That period kind of not only familiarized me with the architecture of the financial system, but created mental models in my head that, I was obviously excited to put to work, as, this, most recent part of history kind of rhymes and offered a similar setup. I guess we've established, credit risk is gone, liquidity risk is gone, funding risk is gone. I think the only other real primary variable that is still up in the air is interest rate risk. Yet even here, this risk, I think, has been, largely completely taken away due to the Fed's actions. So interest rate risk, very simply, is that long-term and short-term interest rates will move in a way that negatively affects ORC spread or book value. Without, getting into the technical details, typically these REITs will hedge out these interest rate risks with transactions in either treasuries or swaps. But for the most part, they are aimed at and have historically been used to moderate volatility in ORC's underlying investment portfolio. However, in scenarios like March, where you basically have, periods marked by widespread distress and deleveraging, you saw rates move, significantly over a very short period of time. And, that caused the hedges in their loan book to, basically, create, very large losses. And that kind of cascaded, on top of, people having their assets seized and margined. You had the additional noise that came from, a significant rate move. Off the top of my head, I think the 10-year Treasury collapsed to a low of 0.62%. From right around 2%. I think it was 1.9%, if I remember, at the beginning of the year. And then the Federal Reserve made two emergency cuts to bring short-term rates down to zero from 2.5%. So, these short-term moves essentially caused ORC's book value to decline by 25.8% in the first quarter. Not exactly great, but a one-time hit. And on the broad side, you had by the end of the quarter, due to the intervention by the Fed, ORC's book value had recovered, some 10.5%, ending, Q1 down, I think 22%. So, the worst was behind him. So you had the Fed step in and kind of remove all of these, risks that historically were very, are very important to thinking about, the risk reward in these businesses. Coupled with, the environment where, you had rates move very fast and essentially, the Fed move into anchor rates at zero. So, This is, I'm going to get to, the most important part, which is the effect of, 0% Fed funds rates and, basically 12 BIP agency repo costs. As a result, that has, greatly increased ORIC's earnings power going forward. But before I do that, I want to talk about two other, more minor risks that, in talking to some, financial analysts and people in the space, trying to get a good idea for consensus. Two other kind of high-level issues that come up are, one, prepayment risks. The risk that borrowers refinance, their loans. Obviously, rates, at all-time lows, or with, the 10-year, having dropped so substantially. That has had, somewhat a relatively muted, but a somewhat of effect, bringing down, 30-year mortgage rates. As that happens, you're likely to see large, a large spike in borrowers refinancing their loans, i.e. repaying them. And that is negative for ORIC or all the MREITs, in the sense that they must replace that paper with, lower yielding paper, which brings down and depresses kind of the net portfolio yield in the process. One thing with respect to this is, while I think, ultimately in time, there's no doubt that you will see a significant, spike in, prepayments. For the time being, and I think this is, you see this historically, in the aftermath of periods like the financial crisis, but, typically during difficult periods, prepayments are muted for, call it 12 to 18 months after the initial event, largely because, it's hard for borrowers to refinance given, log jams and loan approval processes. This is kind of a risk, more specific to the impact of COVID-19. But you can imagine with, the PPP programs and everything that's going on kind of broadly, the ability to, kind of simply work through the loan approval process has been tough. I actually should have footnoted a link that allows you to kind of follow the prepayments in the industry, somewhat in real time, that I think is a great resource. But the point is that you've seen the rates in general drop. Typically you would see a big spike in refinancing, but because of the logjam in the loan approval process and typically tighter underwriting standards that come with an economic environment where nearly a third of the country has where we've had all-time high unemployment rates and everything that this crowd broadly knows better than most. So for that reason, I don't see, and I think some of the smarter management teams of the space, I think would concur. The real-time data suggests that prepayments should remain relatively muted for the next 12 to 18 months. Second, there's the issue of higher hedging costs. Obviously, like any option, when you have periods of very high volatility and wild moves in kind of rates across the curve, that's going to cause the price of protection to spike in lockstep. And in turn, these MREITs, as they kind of look forward, I've heard some concern that, they're going to experience much higher hedging costs, and, that headwind is going to, eat in at the margin to, kind of the expanding NIM that I'm about to dive into. But, two interesting things here. One, I think, given all the uncertainty in the world, kind of the, importance of, the mortgage market in particular, it's kind of the fundamental pillar of the general, U.S. economy. They are, the government is going to, veer towards keeping rates lower, for longer, and pretty much whatever the future holds, it's very hard for me to envision a scenario where rates, materially move up from here. ORIC's management in particular, in response to, kind of the current, the economic backdrop, has kind of done two things. One, it's hedging considerably less than it has in the past. So, that will nullify the higher hedging costs, component of, the larger risk equation. Largely, that will mute the impact, largely in and of itself. I think more interestingly, and our two largest positions within the, MREIT basket is, Orchid and AGNC. One of the things that I love about the combination of the two together is, the inherent balance, between them. And by that, I mean, ORC hedges are essentially, focused on protecting against lower rates, where, AGNC's hedges are, primarily positioned to protect against higher rates. So, if rates go lower, I think ORC will be protected in a very unique way. And again, given the full faith and power of the Fed, in terms of their ability to control the short end of the yield curve, and anchoring, short-term rates at zero, barring a scenario where, basically the Fed, is, confidence, we have a run on the currency and the full faith and, credit of, the Federal Reserve is no longer money good. A scenario where interest rates rise materially on the short end over the next 18, say 12 to 24 months is incredibly low. So let's see here. All right. So this is kind of the, the heart of the thesis with respect to why we find it so attractive. I mean, the discount to kind of a growing liquidation value is attractive in itself, and the margin of safety associated with that makes I think the idea objectively attractive in its own right, on that alone. But where things get really interesting is how the Fed has essentially call it partnered with banks and businesses, or actually banks, given the dividend and buyback restrictions that were just done, are actually not set to benefit in the typical way that ORC would. But the point is that the Fed's actions have created much lower agency repo costs, and that is in turn creating a much bigger mortgage repo spread, and thus greater earnings power. As the spread between the interest rate ORC pays and receives, pays on the short-term repo side, which is essentially free money now, and receives in terms of the 30-year mortgages that are kind of the proxy for what the yields will be on new issues, additions to their portfolio. The net interest margins will expand in basically a step change fashion. And, the delay in this, kind of rollover is, I think, where we are right now. And part of the reason the mispricing still exists. So, the temporary lag, which, I think the vast, basically the entirety of their, repo paper will roll over within the next year. As that happens, right now we're in kind of that interim period where, the full effect has just begun to kind of flow through its financials. But, rain or shine, eventually, this short-term financing will roll over and be replaced with essentially free money. And, while, it's true that mortgage spreads have dropped, somewhat, for the most part, they've held relatively strong. And you've seen their kind of, the spread is two things. It's the money they earn, the net portfolio yield, which is caused by, or kind of anchored to 30-year mortgage rates, and the cost of that financing, which, I believe at the end of Q1 was 2.74%, which now it has dropped, substantially beneath 1%. So, if your, net portfolio yield on your investment portfolio is flat to slightly down, and, the cost of, funding for that portfolio kind of drops through the floor, very good things happen to earnings and, by extension, the dividend paying capacity of these businesses. So this next slide is kind of, a reflection on, what I just discussed. You have a scenario here where, the NIM has kind of, exploded. And this increase is largely driven by our cost of funds going from, 2.74% through the rear view to, it's kind of incredible, but, so substantially below 1%. This, kind of simplistic model right here, and I'll illustrate, where this kind of data comes from, but it is basically backed into by hints that management itself gave to on the call. But simplistically, just think about it like this, through, March 1, I believe, and I'm not 100% sure, but memory serves, they had, their net interest margin was basically a 162 basis point spread. That new spread, that's saying, the business now, because of the Fed's actions, will now earn something, on the lines of a, 340 point spread. Play around with the numbers, come to your own conclusions in terms of hedging costs and, all that kind of stuff. But at the end of the day, regardless of whether it's, the new normalized NIM is 350 basis points or 250 basis points, the point is that it should expand materially. Just to kind of do a simple walk, they have a roughly, as of June 1, you had mortgage rates still in the low threes. On Oryx, roughly $3.4 billion investment portfolio that is, essentially 11% equity finance, so, 9 times levered. That portfolio should now be able to spit out roughly $116 million of net interest income, subtract, operating expenses. And what I did here is simplistically took OpEx from Q1 and kind of rolled that forward on a run rate basis. And what you have is, after subtracting operating expenses and accounting for, the 90% of the $105 million in net interest income that they will generate, basically distributable cash flow of, roughly $95 million going forward. So, effectively $1.44 per share. Why this is notable is that, Oryx stock price currently trades for $4.36. So, obviously the market has clearly not paid attention to the step change in Oryx earnings power. Perhaps that's not necessarily surprising given its natural shareholder base, has only really ever cared about one thing, and that's, the dividend yield. Additionally, you had, kind of the entire sector destroyed in March. And, as, this kind of low information shareholder base crowded the exit, there's going to be some period where, they are psychologically averse to, returning. At the same time, I think it's only a matter of time before they do. I kind of want to, before I move on into the options portion of this, I want to talk, think about how absurd the current price is. Oryx investment portfolio largely consists of agency MBS, which the government has guaranteed the timely payment in principal and interest. So we have zero credit risk. Moreover, the Federal Reserve has taken the funding risk off the table, and they've done so through their unlimited purchases of agency MBS. And through that and cutting interest rates to zero, these things have dramatically enhanced Oryx forward earnings power. Yet you have a situation where this kind of risk-free portfolio, is trading at, approximately, 3.4 times earnings, or actually less than that, going forward. When you think about the, kind of fundamental earnings power on the, post-March portfolio, which, you know, interestingly enough is much smaller than the portfolio prior, because of the NIM expansion, you know, you can, you know, reasonably see scenarios where the normalized yield on ORC's, you know, reset and smaller investment portfolio is approaching roughly 30%. So I find that, you know, really quite remarkable, given you have a scenario where the 10-year is substantially below, you know, 1%, and you can buy paper that, you know, is basically, you know, underwritten and guaranteed by the same creditor, i.e. the, you know, the federal government, and, you know, paper that is basically paying you know, over a 30% yield. So given a similar, call it a credit risk profile, I feel like, you know, it's positively insane to not, you know, there's no way you're going to see a scenario in the future where, you know, a 30% yield and, you know, sub 1% yield on, you know, basically equivalent securities, in the sense that, you know, they're both money good, you know, where that spread does not compress substantially. So. You know, one of the things that, you know, we do at Crossroads that, you know, has been kind of a part of our value-centric approach from the beginning is, you know, look for things that we call, you know, quote unquote, compound mispricings. I started out of college trading options at the Chicago Mercantile Exchange, and forever since I've kind of used options as a overlay where, you know, if I can find a stock that I think is, you know, both deeply undervalued and, you know, intrinsically very, very attractive, you know, given the kind of the magnitude of its mispricing, and options on that underlying stock that are themselves mispriced, you have a beautiful setup, which again I call compound mispricings, where you can kind of get the best of both worlds. In our case, we, you know, purchased, you know, we went long the common stock at the same time, you know, we, you know, decided to write a significant amount, or I should say an equivalent amount, of January 2020 puts, which allowed us to, you know, basically purchase, you know, lower our purchase price on this, you know, unlimited money pure play, and ensured that we get paid, you know, to wait while the cost of funding on the existing book resets. You know, that basically creates a scenario where we have, you know, basically a highly attractive risk-adjusted return under a very, very wide range of outcomes. You know, while that resets, we'll profit, you know, if the share price rises, stays flat, or drops as much as, you know, 19% over the coming 7 months. You know, at, you know, its most recent price, you know, you have a business that is trading at, I believe, 87% of book value, paying a mid-teens yield. I believe it's 14.25%. And that assumes, you know, no enhanced, you know, earnings power going forward, or I should say expanded NIM. So, you know, I guess even before you get to the option side, you have, I think, a very unique and highly asymmetric setup. Well, with options, we were able to essentially lower our break-even price down to a level that, you know, approaches, you know, I believe it's 60% of book. I think I have 73% of book. So, you know, that in itself is very, very, I think, attractive. You can buy a business, you know, instead of it being an 87-cent, you know, dollar, you can, you know, write options and bring that down to, again, 73% of, or 73 cents on the dollar. Why do we like selling vol with, you know, ORC in particular? Again, you know, because of all these unique features, you have a business model that is essentially unaffected by the impact of COVID-19 lockdowns. You have, you know, downside limited by the large discount to book, where that book value is, you know, almost certain to increase going forward. You know, unlike most businesses where, you know, within all this uncertainty, you know, one of the things we do at Crossroads is, you know, and this is, you know, why we emphasized early, you know, our preference for very defensive, you know, stable, highly resilient businesses with staying power. that are likely to hold their own, if not grow, their earnings capacity in difficult times. This is, very, very important to us. And so, Oric, through, kind of an ironic twist of fate has, was the opposite of those things and has become kind of exactly those things. In this case, it's not a business where, looking out 12 months or 18 months, a business that looks very, very cheap on trailing 12-month earnings ends up becoming kind of the definition of a value trap as those earnings proceed to get cut in half or more. This is very much a situation where earnings will not only remain where they are looking forward 12 months, but, are actually set to grow significantly. Again, I mentioned earlier, you have kind of this Nirvana-like backdrop, an environment where, the, kind of ultimate upsurge and prepayments will be delayed due to Corona specific issues and the effects that come with that, and then just the natural increased underwriting standards that come from periods where you have, significant economic distress. You've seen that, kind of the revenue line with respect to the yields available on 30-year mortgages has remained largely stable. And we expect it will continue to remain stable, looking forward. You kind of put these three things together where you have basically free financing, repos by, the government at all-time lows, prepayments likely to stay low, and the revenue line, the yield on, their investment portfolios available from mortgages, all kind of, coming together in a way that should be, a beautiful backdrop for the business to grow its earnings in the years to come. So in terms of, why we wrote the January 2020 ORC puts, again, this creates a setup where as all this stuff, plays out and its cost of funds, or its higher cost paper rolls over, we can, basically get paid to wait as that happens, and get paid, kind of very almost in a usurious way, for writing this insurance. Anyone that can, has ever studied Warren Buffett knows that, selling insurance for unlikely events at very, very high prices, is a pretty great way to compound wealth. So it's allowed us to kind of skew what was already a very asymmetric risk reward even further in our favor by kind of following his lead. Next slide. Or I guess let me go over this real quick. So again, over this period, this is setting up for, a 62% return on capital that is essentially, guaranteed as long as the stock doesn't drop, more than, approximately 20% from its already significant discount to book. In some respect, I think the equity until all of these underlying catalysts, become kind of self-evident and apparent, going forward. But, in the meantime, the stock is somewhat of a trading sardine that trades, in just truly bizarre ways, like a lot of small cap names that, make it appear that the market's kind of discounting mechanism is fundamentally broken. In the past, MREITs, appeared to trade, with a clear relationship to the underlying drivers of their business. The correlation, over these last few months, relative to those kind of the fundamental drivers of its business and the up and down, daily swings in its stock price has kind of broken down, and all that volatility has created, kind of the mouth-watering premiums that are part of the basis of this idea. So as you can see, the annualized, IRR, it's shorter duration trade. The profits, are, I think, very predictable and relatively certain. And in the worst case, you end up buying, a dollar bill for, much less that you'd already want to own more of in the first place, because by the time these puts expire, the earnings power should start to flow through the financials, and the dramatic kind of re-rate in the underlying towards tangible book value, or more likely, call it 1.1 to 1.2 times tangible book value, will take place. So real quick about the, option volatility, and I kind of want to run through this real quick. So, there are three kind of, like all of the confluence of events that have come together to create the unique setup in ORIC's underlying common stock. I think we have a similar dynamic going on in the options market. And, it's basically kind of a three-pillared stool, where the first is, recent realized volatility in small caps has obviously been off the charts. You had one of the swiftest and, steepest drawdowns in capital market history through mid-March, and, an equally violent rally off the lows, through the end of June. Naturally, this has caused implied volatility to spark, and, created, as part of the equation that has created the attractive option pricing for, certain names that are, call them COVID proof, that, are not going to have their earnings power cut in half, but, the opposite will be true, where the amount of money they make next year and the year after will actually be far higher than it was before, despite, again, a much smaller post-March, call it margin call, death spiral investment portfolio. So you have that. In addition to that, you have the uncertainty about, the second wave factors we're dealing with right now in terms of COVID-19, and the ultimate impact on the real economy. You have the election issues in, all of the protests and riots related to kind of socio-political and economic factors that make, I think, the range of potential outcomes looking forward particularly huge. Given the small cap spaces, greater economic sensitivity and vulnerability to kind of broad general business conditions, it makes a lot of sense that, you would see, historically speaking, very elevated volatility, in the space, for that reason alone. I mean, they're just ultimately, more vulnerable to increases in cost of capital and all of the things that will come in, kind of steep and severe economic downturns. And then finally, you have the listing of weekly options, plus the advent of commission-free trading, and the kind of surge in, the day trading by what I, view as basically, bored sports bettors that, are looking for something else to gamble on. And in the process, with Robinhood and the Wall Street Bets crowd and all of that kind of well-known, phenomenon going on, unsurprisingly, this has created, very large swings in certain stocks and options. I mean, we saw Hertz and, Chesapeake, where, not only was it clear the equity was a zero, but, many of the bonds, appeared to be zeros. And yet you see their equity, rip by a factor of 5 times in only 3 days. So that factor, in conjunction with the other two, have kind of all come together to create this perfect storm of, structurally elevated volatility in, the options market when it comes to small cap businesses. So again, this high implied volatility has created very, very attractive prices. I think for most businesses, selling volatility in this environment is, akin to, what amounts to picking up pennies in front of a steamroller. And, while I think selling volatility in very, in a very discerning and thoughtful way is always something that kind of stacks the odds in your favor. I think right now, the prices that can be commanded for selling essentially short-term insurance at hugely, out of the money prices. One of our holdings, for example, that has done particularly well. I think I was able to sell, out of the money calls that were, I think, 25 or 30% beneath the stock price for an implied cash on cash yield in the 20s, which is just nuts. But the point is that while it's very important, all investments in this environment, to be very, very discerning, and to pick your spots. This is especially true in the options market, but you have certain names like Orchid, which I essentially view as bulletproof, that aren't affected by the COVID-19 fallout, the social and political upheaval, and the other pressing issues that are pushing volatility up. For that reason and that reason alone, it creates just a very juicy opportunity to lower your risk and increase your return. So outcomes range from pretty good down to downright amazing. So this is kind of a good way to think through how we've kind of narrowed the range of outcomes. I mean, in general, we want very predictable investments that not only should not only have staying power and will hold their own in difficult times, but we want the presence of kind of multiple catalysts that should force price and value to converge on a defined timeline. And the easier we can narrow the range of future outcomes and kind of reduce our downside, the better. So in this particular slide, you can think about, 3 separate scenarios. Obviously there is the implied upside from just going long the common stock at 80 cents on the dollar at a mid-teens yield, where, I guess what you could, I wouldn't really call it conservatism, but, kind of irrationally conservative, where you assume that the embedded NIM expansion in the business, for whatever reason, is not realized. I mean, absent, say 30-year mortgages, a world where we have negative, mortgage rates, which, unlike kind of interest rates is truly inconceivable to imagine, but, the spread should, hold up and or at least not, contract under, any realistic future scenario. So if you just assume, the status quo with the existing kind of run rate dividend, you're looking at a forward, 1-year return. And by the way, this is meant to, the framework here, the structure is there's, there's the shorter duration 7-month period where we get paid to wait and kind of lower our break even, i.e. cost basis here. These annual returns are looking forward a year, 1 year after that period. So, after the NIM has expanded, due to the, paper rolling over towards, lower rates. Well, in that case, you have not only the hugely attractive, what was it, 62%? Yeah, total return, on that period. You have the basically the implied upside from a return to tangible book. So that 87-cent dollar, or I should say 73-cent dollar, given you've been paid dividends and option premium in the interim to wait. You can benefit from kind of the reversion as the capital appreciation as the multiple re-rates towards tangible book. So obviously I've not assumed the break-even price in this plain vanilla long scenario. I'm just assuming you buy it today and you wait. So you get the 15% from that and you collect your dividend yield, you get a 29% return. Well, this is where things get really interesting when you think about the, forward situation. And I, as always, caveat emptor, I, very much recommend that investors that are interested in this name do their own work and come to their own conclusions. But, you, in some sense, you don't have to take my, word for it on the magnitude of the embedded uplift to come. Management, which I will run through the quotes in the next page, have, kind of coyly winked at, the dynamics that I just discussed in the March, conference call, kind of in the aftermath of all of the distress. And the first, comment they made, and he actually reiterates this twice, is, because of the dramatic drop in our, economic cost of fundings and a relatively stable, net portfolio yield, which I believe was 3.69% as of June 1, you have a scenario where even a smaller portfolio, by, say a 20% smaller investment portfolio, because of the expanded NIM, should be able to earn, its dividend paying capacity should be able to return to what it was prior to the, cut in early April. So, we purchased, our initial position prior to that announcement. It's pretty easy. These are simple businesses. You could kind of back into what the post, distress book value was. It was somewhat obvious that the dividend would be cut in, kind of a direct relationship to the shrinkage of the portfolio. So if, the dividend is paying X and, the portfolio shrinks by Y, the new dividend, will, reflect, a similar drop. So if it was paying a, 10 cents per share, and it drops 30%, it's likely going to be paying 7 cents per share. So you kind of back into the composition of the portfolio. You had all the risks removed that we just mentioned, taken completely off the table. And, the first catalyst of the investment idea was, the announcement of the forward dividend yield, which, obviously lots of people were concerned and they didn't know, if it would be cut entirely or what magnitude. We thought we developed a relatively, I don't want to call it an edge, but it was clear to us that we had been able to narrow what the, run rate dividend that they're paying now would be within a fairly narrow range. And so we got long before that in anticipation of that uncertainty being removed in the stock, repricing as a result. And, it has substantially, the stock is up quite a bit, but, it remains what we think to be, unusually, in fact, extraordinarily cheap. So what happens if management's hints that the business should be able to return to the prior dividend re-rate of prior to, the first 3 months of the year, which is 0.08 per month on the stock. And, that is, I think, interesting in itself. So, on the current price, that puts, ORIC's kind of, run rate or, forward dividend yield, north of 20%. Obviously very, very attractive in a world where the 10-year is sub 1%, and, sources of stable income are increasingly scarce. That type of yield is almost certainly going to compress and drive considerable, upside in the, stock. The third scenario is the one that we had discussed prior, right here. This is what I call the unlimited money scenario, where the full power of the Fed's actions and the moat that it provided really, expands the, the forward earnings power and NIM of the agency reach in ways that, is, I think, kind of almost shock and awe in, the magnitude of the uplift. So in this case, where they're able to pay out essentially 12 cents a month on a much smaller dividend yield, you have at the current stock price an implied 30% yield. If you use the options trade, and you decide to short volatility and do the options twist side of it, your implied break even or the yield at your implied cost basis in the unlimited money scenario goes, spikes to nearly 40%, which is crazy. So these names obviously historically tend to trade on yield and book value. The way I see this coming, kind of fruition is eventually the paper rolls over. You have a very predictable level of very high visibility into a step change inflection in its underlying cash flow. As this cash flow starts to flow through its financials and bleed into its dividend, you're going to see the stock re-rate. I think more likely, whether it's the normalized yield or the unlimited money yield scenario, you're going to see the stock and the book value rapidly accrete higher and start to trade at the premium that it deserves. So in a scenario where it goes to 1.2 times book and they are returning to the unlimited money, or the unlimited money NIM comes to fruition, you're looking at a massive 67% return just to go to the re-rate and book value, plus a implied dividend at your break even that is, on the order of, nearly 40%. So, regardless whether it's 20% or 40%, you don't need to scale to no man's fat. You've clearly got, I think, a very low risk, scenario where you could generate, kind of super normal profits, whatever the future holds. In a essentially risk-free way, where the predictability of the ultimate outcome will be realized regardless of what happens in the general economy, whether the S&P is up or down over the next 18 months. So speaking to the don't take my word for it, here are some hints in the latest call that have kind of tied into our numbers. NIMs in the market, net interest margins available today are very attractive. I won't regurgitate, these paragraphs here, but I think two things are worth noting. One, management notes that, given the step change inflection in their NIM, that their cost of funds, due to their cost of funds dropping, you're going to see significant expansion in their NIM. And that in itself is going to allow them to, see some upward movement in the dividend going forward, with the, dividend returning specifically to the 8 cents that you saw prior to the new, monthly dividend in April. If that's the case, obviously the stock has, considerable, low risk upside. More interesting still, I think, is the explicit guide by management that discusses, in the Q1 presentation, there is a slide that goes through their interest expense, repo expense, cost of funds, and the average cost relative to the size of the portfolio, over the last 4 years, and you've seen basically a consistent drop over time. But management specifically, and they get kind of cute and coy with it, and don't say it directly, but they note that it's going to go from basically what amounts to 8% or 0.08, 8% per quarter, or 8 cents per share per quarter, to roughly 0.35 at the midpoint, 0.035 at the midpoint. Per quarter. So, it's the language between the dropping from, 8 cents per share per month to 0.35 per share, 0.035 per share per quarter, which is basically, it basically implies that their, repo expense is going to drop on the order of 85%, once, this transition that we've kind of outlined throughout the presentation resets. And that, you kind of back into, you can play around with the numbers and do it yourself. But the point is that 0.03 to 0.04 per quarter estimate aligns with the, basically the forward NIM that we outlined right here. But, double it if you want. Hell, triple it. And, you're going to find that, in the end, the ultimate outcome is the same. Maybe, the unlimited money NIM scenario ends up being aggressive at the margin, cut it in half. And, I think the incredibly attractive nature of the setup will remain the same. So that's basically it. So in summation, ORC is an agency MREIT, that fits, I think, firmly in our special situation bucket. These are scenarios that, the realization of value is ultimately dependent on company level actions and outcomes, not, the health of the general economy or whether the broad market is up or down. By nature, kind of this grouping within our larger, strategy is, the type of investment that is intended to outperform in down markets, and shorter duration, and usually non-recurring and always opportunistic. So we think ORC fits that bill kind of beautifully. In that, with that in mind, we know that, in an environment where credit risk is the last thing you want to take on, given the uncertainty, ORC has, essentially zero credit risk. Its investment portfolio is guaranteed by the U.S. government, creating a, temporary, but, basically bulletproof, Uncle Sam provided, 18 to 24 month moat that should protect their ability to earn outsized, returns. Second, you had, a classic scenario of forced selling and low information investors that basically had their hands burned on the stove. A lot of the, kind of as the U.S., demographics continue to age. A buddy said you can't pay for, new golf balls with 25-cent CDs. And, I think that kind of gets to the heart of it. Eventually, the people that were kind of shaken out will return for the same reason they always do, a predictable, yield that once they realize is stable and will continue to grow. If not them, certainly their financial advisors will rediscover their religion for, this particular class of securities. Again, ORC offers, all of these factors are essentially supported by and underwritten, by the United States government, creating a very predictable outcome that is unique. Second, all those factors, in conjunction with the various things that are underpinning the elevated levels of implied volatility and highly attractive pricing for those willing to sell options, you put those two things together and you can essentially buy, this dollar bill at a huge discount to growing liquidation value. Should there be, a temporary downturn, in the shares of the stock, this is absolutely one of those businesses where we would, happily buy more. So by selling options, we, lower our cost basis, increase the range of profitable outcomes, allow ourselves to get paid to wait, while the, inflection in earnings power, the portfolio resets and that kind of bleeds through the financials. And worst case, short-term volatility, we, end up buying more shares at a lower price. That's something we'd be happy to do. So ultimately it's, a classic heads we win, tails we don't lose situation. In a world where, finding, not only certainty in an increasingly uncertain world where, rates are zero, and the demand for income-seeking securities is going to only grow, looking ahead, this is a unique way to not only, sidestep, the oncoming storm should it be realized in the U.S. domestic economy and globally, But, we think it basically allows you to kind of dance in the rain, with very, very low risk, without having to, it creates certainty where there is none. And, for those that seek to understand and manage the uncertainty in this world, I think these investments offer a very unique way to kind of sidestep the issues that we all face as investment managers, where our jobs are continually getting harder, given all of the factors that affect, our mission of preserving capital and generating outsized returns over a full cycle. So I think this is a very timely and opportune way to, not only stay invested, but do so in a way you can sleep at night and still, profit regardless of what the future holds. So that's basically it, John.
Ryan, thank you so much. Truly a very interesting idea. And even though this is Wide-Moat Investing Summit, I'm glad you chose to present this. I think it's very timely. Can you talk a little bit about how you think about sizing this kind of position within your portfolio and how the put writing impacts how much collateral you need to have?
Yeah. So, obviously this isn't something, as our fund we've always held lots of cash. That's not because we, are market timers. It's because, we have a very high bar in terms of, our kind of the hurdle that we need to underwrite investments. And so in the absence of opportunity, we tend to hold large amounts of cash. So, this isn't something where we're fully invested and we're writing options, at the margin where if the market goes down, we're going to, it's going to put us in a situation where we're going to have to lever up the portfolio to hold. So, the way to answer your question, I think about it as a way to, when we have an elevated cash position and, obviously until, I'd much rather add, to a position as the thesis, is incrementally proved out over time and pay marginally higher prices. If I think the upside's, 100% and, I have the choice between, buying today and, running into a buzzsaw and paying up, 20% more for that remaining 80% or so of profit. I'm going to take the latter example every time. So, what we've done is we bought a basket of these agency REITs, heavily weighted to our kind of top two positions, which are ORC and AGNC. And, we've sized it, I'd have to go back and look, but, our position in the common is, I believe, so somewhere between 6 and 8%, the entire basket. But the options we wrote, would bring it up to, slightly over 10%. So, we're very concentrated investors and, we typically only need to find, 3 or 4 great ideas a year to, do what we do. But, I tried to balance, I think I don't see any downside really under any scenario for all the reasons I've said. There's no way where, the buzzsaw of the margin calls and all the things that created the cascade in March that's going to lead to decreasing book values, is going to kind of destroy the embedded value that's already there. This isn't a scenario where a dollar bill is going to become 70 cents under really any, future outcome that I can imagine. So, at the same time, I'm always, especially over periods where, we've done, very, very well through this whole period. And, kind of when I'm in a period of an extending winning streak, I'm always ever vigilant against risk, but I'm, in periods like this, I'm even more acutely aware of, what can go wrong, just because it's times where, you think you're smart and clever and you've done well, that you're likely, one step away from getting your head chopped off. So, we didn't want to go crazy with these, but we also wanted, the investment to be big enough to where, we get paid for the kind of the insights that we have discovered. So we kind of split the difference and made it, a position big enough in the common to where if it goes up and we don't get put our stocks, we don't end up buying more. We still do very, very well, but, I wouldn't go whole hog and put your entire portfolio with these things. The future is uncertain. While theoretically the downside should be minimized, I'm sure, we're all not alone in knowing that, things, that you can't imagine happen all the time in this world. So, we haven't made it super big, but, we have sized it large enough to where, it will, move the needle should we not get put the, additional shares. And, if we do get put due to short-term volatility where, it's big enough to where we're happy to hold. It's not too big and we're happy to hold for the long term. One of the things that, people always talk about, and by the way, this is kind of an adjacent rant, but I forgot to discuss it. One of the things we often heard was, MREITs, look at book value. It's been, basically relentlessly being degraded, since this company became public. And, when I hear that, while, yes, that's technically true, speaking about, I guess, trends in book value without reference to the yield curve, and the conditions. I mean, any spread-based business, talking about trends in book value without, relating that to the yield curve environment, if the period in question, is obviously, kind of meaningless noise. So, I think if you look back, I think the yield curve really started to invert in 2015. If you look back through the financial crisis, which I think is very analogous, in the way, the government then, created a scenario where, they had lots of losses, but their NIMs, had basically doubled. And so their earnings power, their ability to absorb, all these losses. And by the way, that's part of the reason why the Fed has taken those actions, was to strengthen the financial system to be able to withstand a period of elevated losses going forward. And, so I mentioned that because the real applicable period here to think about trends in book value and cash flows is, the period from the financial crisis, the immediate aftermath of that through, I think, 2013, where, instead of, scenarios where like the rear view where, for, going on 5+ years, those trends have been nothing but negative, for this type of business. Going forward, it's basically, again, nirvana. And, the applicable period to think about what the future holds is not, Orchid, wasn't public way back then, but not how things have unfolded over these last, 5-ish years, but, how things unfolded during that period immediately following the crisis.
I might have missed this, but can you just talk quickly again about the timing of the higher cost paper rolling over?
Yes. So I wish I had the slide, but, off the top of my head, all these businesses are in a constant state of refinancing. I believe the average duration of the paper in their, $3.4 billion investment portfolio is approximately 32 days in average maturity. But, the point is that you're going to have over the next 6 months to a year, essentially the entire, financing base rollover. So, as of June 1, you're just starting to see this. As of June 1, I think it was 2.66%. But if you go through and, there are tables in the presentation and even the June 1 presser, where it basically, lists the, average repo rate, the average, days of maturity, and you can look at that and get a rough idea of, what the cost is going to look like going forward.
Okay, so pretty fast.
Yes,
And
yes.
then do you have a sense for how the dividend adjustment could work here? You know, what kind of time frame would we see
Yes,
there?
yes. So I think, if if you read, very closely management's commentary, and this goes back to, their comment about, their, average cost of repo, their repo expense going from 0.08 per share per month to 0.355 per quarter. It's going to happen relatively quickly. And, that is, I mean, it's going to flow through. I mean, I wouldn't be surprised if, within 2 quarters, you start to see, not only that dividend raised, but, and I think this is really one of the things that kind of shocked me when we were kind of doing all the work and, scrambling to, underwrite the name in a way, obviously timing was sensitive and we knew when they were going to report the new dividend. Uh, but, we wanted to make sure that, we had a very, very high, level of confidence in, the kind of the speed at which, these expanded NIMs would start to flow through their, dividend paying capacity. And I think that, I'd be shocked if you don't see them start to raise the dividend materially within 2 quarters. Did I answer
And
your question?
yeah, absolutely. Thank you. That's very helpful. And just to make sure I understand the nature of the assets correctly, so there's really no risk here of the curve steepening either. So on the long end, this wouldn't affect it, right?
No, I mean, if the curve steepens, that's good. Then their NIMs go wider. So if you think about the long end of the curve, typically in the Fed, you saw this in the financial crisis. They did two things. Not only did they pin rates to zero, but in various ways they attempted to push the far end, the long end of the curve up. And the reasons behind that are obvious because if you don't want an economic and public health crisis to rapidly in 2020 to rapidly devolve into a financial crisis on top of that. One of the things you need to do, and you kind of see this with banks and the PPPs and all this stuff. And this is related to their ability to absorb the loan losses when the banks' inability to pay dividends and buybacks and all that stuff. What they're doing is they're purposely trying to expand the NIMs of the financial system in a way that allows them not only to become fundamentally stronger, but to absorb any economic fallout that comes. And so in a sense, they're like a small minnow next to a larger pond, where it is basically being swept up in the slipstream of the Fed's actions related to shoring up and strengthening our financial system to navigate a particularly uncertain and potentially a scenario where there could be significant loss. And they basically benefit from, that NIM expansion, as a byproduct of, the Fed's kind of primary goals, which is, again, to shore up and protect, the strength of our financial system. And, the way they do that is effectively in various ways work to, expand the NIMs of the businesses that underpin, our economy and capital markets. And I think that's why you saw the shock and awe reaction in March is because, the mortgage market, the mortgage markets, if they don't function properly, most of America, almost all of America's, the majority of the net worth is tied up in their home prices. And that's just fundamentally a non-starter. And they're going to do literally whatever it takes to protect that. And so this is kind of again, it's nirvana for MREITs, not because, the federal government is rubber stamping, basically what is generally a bad business. it's about, much larger and more important things, or it just happens to be positioned in a way that sets them up perfectly to benefit from, that reaction and the ongoing support of it. And, I actually would be surprised, I could see, I'm not even sure the Fed, once they, given what they've been doing these last few months, and, I think there's rumors of another trillion, in stimulus coming down the pipe, next quarter. I'm not sure that the Fed can ever, pull back from the extraordinary stimulus, that it has, basically gone, full in on right now. So that's another element of this thesis, why, while it is, I think, fundamentally shorter duration and attractive, because I think you have a couple of hard catalysts that will drive a predictable re-rate, in the near term. Ultimately, I wouldn't be surprised if, this kind of perfect storm setup for the NIMs of the agency MREITs lasts for a period, multiple years, as opposed to, 12 to 18 months. So, I think that will be interesting to watch and play out. But, for the foreseeable future, they should basically gush cash.
And Ryan, maybe lastly from me, at the outset, you mentioned that these kinds of vehicles are often just management compensation vehicles, and there's, you're kind of, how do you think about, that aspect of it, and what the drag or royalty or overhead, whatever you want to call it, here is annually, or let's say?
Yeah. So obviously, I find it, revolting, as someone that has kind of built his business, solely to, I've built a business that has much smaller AUM and therefore smaller paychecks, in a way to preserve not only the integrity of our investment operation, but, to maximize our clients' long-term returns. When I see the level of compensation, for basically, it'd be the equivalent of me just, instead of trying to run a idiosyncratic, investment portfolio built one idea at a time that, can outperform for, unique insights and, really add value. I just decided, screw it, and, sold all of my positions and ended up going, taking on leverage and buying the triple leveraged ETF and the QQQs. That's kind of what I view these as. I mean, these guys are essentially buying, there's not a ton of ways you can add value. They're basically levering up a ton and, just taking a disproportionate amount of carry relative to the actual value that they provide. So let me be clear, and this is why it said at the beginning categorically, this is an investment that would never find its way into our portfolio if it wasn't for kind of the idiosyncratic, market dislocations and the opportunity that has come because of, a very unique confluence of events, why they would be, this would not be something you'd find in the portfolio. That being said, if you go back, for example, here, this, estimate is inclusive of their ludicrous fees. So, I think, number one, while these, they are in large part executive compensation schemes, for doing nothing and operating in a way that, doesn't really add value or is deserving of the kind of premium fee structure that they have. Ultimately, even inclusive of that, you have a combination that, I don't want to let, kind of a narrow handcuffs or fixed dogma prevent me from picking $100 bills off the floor. And, this is kind of one of those situations. It's not the type of business, where, it's run by a smart and creative owner operator with a ton of skin in the game, which is pretty much the, a core pillar of our regular strategy. where the incentives are right, in addition to attractive paper trails and good businesses and long runways to profitably reinvest. In many ways, this is kind of the opposite of all those things. At the same time, the fees, these forward estimates are all included, in the kind of the analysis here. And ultimately, these individuals, I mean, like Org, for example, I think is, basically two guys in an office in Pittsburgh. I don't think that, the fee angle of it is going to, detract from, the ultimate outcome here. That and, they do own a fair amount of shares. While they get paid more than I think they're actually worth, I do think, our interests are not diametrically opposed. If you look through their various, I think these guys are better, certainly better than average, if not shining examples of fiduciary duty. They're not as good as the guys that are in charge of AGNC. But they're not, kind of the, they're not bad actors or, I don't want to say totally worthless. That's not, what I mean. But, they do seem to pride themselves on, their outperformance relative to the space, since they become a public company. I do think that they want to do well. I do think they own enough shares to, incentivize that. And, if you read their communications and their, not only in their press releases and, investor decks, but listen to them on calls, these, as far as guys running, MREIT businesses, I think they're, some of the best for what that's worth. So that's kind of ultimately how I think about it. At the end of the day, it's, the type of business that has, quite a few intrinsic characteristics that ordinarily would kind of, make me puke in my mouth a bit. But, never say never. The future's uncertain. Things unfold in a way where, something that looks, like X, turns into not X because of the way things, happen. So I think that's the situation here. It's ultimately about, the ability to, in our increasingly uncertain world, to find certainty and predictability, which is kind of the opposite of way broad trends are going, at a price where, again, I don't want to see, the future is always uncertain, but I honestly can't figure out any reasonable future scenario where one does not make a decent amount of money here, let alone lose money.
Great. Well, that's very helpful. Ryan, thank you so much for choosing to present this idea. I think it's very interesting and timely. And I would just encourage everyone listening, if you have any further thoughts or questions, feel free to reach out to Ryan or get in touch with us, and we'll be happy to facilitate an introduction. Thank you so much. Great to have you as always, Ryan. Take care for now.
Likewise, John.
Bye-bye.